I'm John Hanna for CityTV.net here in New York City, and we have Dirk Van Dijk, Chief Equity Strategist at Saks.com, joining us from Dayton, Ohio. Good afternoon, Dirk.
Good afternoon.
How are you doing today in this Valentine's Day?
Oh, well, not too bad. So,
There you go. I'm gonna go get myself some ice cream. Go with that all marketing situation with the Valentine's Day.
yeah, well, you go to Ben and Jerry's, you get the free Stephen Colbert Americone Dream today, sometime this afternoon, I think.
Oh, really? I gotta check it out on Google. Check it out whether or not it's gonna be available here in New York City.
Yeah, well, at least that's what Colbert was saying last night.
Okay. Well, there you go. All right. So, what do you have for us today?
Well, we got a rather perplexing retail sales report today. Uh, the reason I say perplexing is it just doesn't seem to line up with a lot of the other data we got. The total retail sales in January, and these are seasonally adjusted numbers, rose by 0.4%. That was well below the 0.7 that was expected, although still up from a unchanged reading in December. And year over year are up 5.8%. However, if you strip out autos, we were up 0.7% with after being down 0.5% in December, but pretty close when you look at the year-over-year figures at 5.5%. That was actually higher than expected, which was at 0.5. The reason I said this was kind of perplexing is that we get separate numbers for the auto sales. They come out the first of the month, and General Motors and Ford and Chrysler and Toyota and Honda all report their sales, and sales in January were actually very strong. I mean, the strongest we've seen since before the crisis hit, almost with the exception of the cash for clunkers in August '09, and virtually as high as that, just about tied with that. So when you see the strong auto sales being reported by the automakers, and then the government comes in and says no, sales are down 1.3%, one really has to scratch one's head on these. The big thing, the biggest increase significance was a 1.4% increase at gasoline stations, and I don't think that's due to people all of a sudden deciding that they need more 44-ounce fountain drinks. It really is a effect of higher oil prices and gasoline prices, but that's coming after they had dropped by 1.6%, or excuse me, 2.6% in December. So we gained back some of what we lost in terms of gasoline prices in December, but not all of it. Looking at it, sort of looks like the areas that were strong in December were weak in January. Autos were very strong in December, up 2.9%, but down 1.3% in January. Furniture was off 0.2% after being up 1.9%. Electronics actually rose after a disastrous December, where they were down 5.1%. In January, they were up to 0.5%. So, I mean, we're seeing a little bit of better numbers in some of the more discretionary areas. Sporting goods and hobby shops up 1.1%. General merchandise, which includes the department stores, up 2.0% after a 0.7% decline. But other areas that are more discretionary, saw some weakness. Most notably, I mentioned the auto parts and the furniture stories, and I kind of like to look at the discretionary versus non-discretionary areas in the retail sales report, which is really tells you more about the consumer, appetite to go out and really spend. I mean, people are going to spend in the grocery stores and the gas stations, kind of regardless of how the economy is doing, and so most of the changes that you see there is going to reflect price changes, not people deciding that they really want to gorge themselves or drive a lot more miles. But when you look at things like are people going out and spending money on electronics or new furniture or appliances, that tells you a lot about how the consumer is doing. And it looked like a fairly solid report on that front, with the glaring exception of that auto and parts, which simply does not line up with everything else we know. I don't know what is going on with the government data collection on that one, and I suspect that we're going to probably have a very big revision in the auto sales numbers to line up with what we're seeing from the actual auto manufacturers. But even though the overall was below expectations, that was entirely a function of the auto market, and that looks just plain goofy, given the other data out there. So, we've got retail sales, growing at, 5.5%. Now that's nominal, but, inflation has been running, sort of 2.5%. So that equates to, about 3% real growth year over year in retail sales. That's pretty healthy. Not a boom, but we're definitely seeing the consumer is back and active and part of the economy. So overall, this is a relatively solid report, even though the headline looked on the weak side.
Well, there you go. That's Dirk Van Dyke, Chief Equity Strategist at Zacks.com, joining us from Dayton, Ohio. And I'm John Hanna for CDTV.net in New York City.